Hi everybody, it's AJ speaking. This is a quick review of Meta's second quarter results, which were released about 9 hours ago in aftermarkets. Stock is currently up over 12%. As I had discussed last quarter, Meta is performing exceptionally well, and this quarter was just a repeat of that. That's why I believe this is not an overreaction, but is actually totally justified. I just sent out to my subscribers on X this alert, and we'll go through everything in this video, but I will just read off the bottom line right at the beginning. I have to repeat what I said last time. Meta performs exceptionally well. True. Number two, I'm blown away by the numbers. Also true. My expectation is that analysts will be upgrading their price targets on Meta. This will further fuel the stock. And unless we have a major pullback in the market, I think the stock will now hold a new trading level. So now let's talk about the numbers. So this first chart shows you total revenue development. The second quarter was up 22% year over year, which is crazy for a stock, for a company the size of Meta. They generated 47.5 billion in revenue. So they added year on year over 8 billion incremental revenue. So the increment is larger than most S&P companies' quarterly total revenue. And please note this scale is broken. It starts from 2025, so you can see more clearly the changes. Last year, for the full year in 2024, Meta brought in 165 billion in revenue. In the first 6 months this year, almost at 90 billion, up 19%. So crazy growth at this scale. So this totally solidifies Meta's position in the Magnificent Seven. Now let's look what this meant in gross profit terms. So quick recap, gross profit is revenue less cost of revenue. And gross profit is up 23% to 39 billion in the second quarter. The first 6 months are up almost 20% to and brought in 74 billion in gross profit. The gross margin held at a very strong 82.1%. This just shows the software nature of Meta's business model. It is extremely lucrative. The only larger company that achieves that level of gross margin is Palantir. So in terms of gross margin, Meta is in a very, very small group of companies globally. Ballpark at this size. Now let's look at operating expenses. So quick recap, operating expenses include R&D expenses, so research and development, marketing and sales expenses, and then general and administrative expenses. Meta has a giant operating expense base. They spent an all-time high in the second quarter. That's 18.6 billion. That's up 10% year on year. The first 6 months are up almost 9% year on year to just under 36 billion. And in the full year of 2024, Meta spent 65 billion operating expenses, so a giant operating expense base. But the absolute numbers don't really matter. That's why we need to look at it in a relative basis. And this is what this chart shows. This chart puts operating expenses in relation to revenue. So operating expenses divided by revenue. So this chart shows percent. And we can see that what I call OPEX margin has actually improved. OPEX margin decreased by 4.2 percent points year on year to 39.1%. For other types of business, like for example automakers, which I cover extensively, this would be insanely high, but is quite normal for a software type business like Meta. And when you look at this long-term trend, you can see that despite the crazy growth in OPEX, Meta has actually become more efficient. So bottom line, even though OPEX growth looks high, it's outpaced by revenue growth, and that makes Meta more efficient. So for example, these crazy AI talent comp hikes that you have seen that were coming out of Meta, where people get paid hundreds of millions of dollars, Meta can actually afford that. But now let's look at what was actually driving the OPEX. And you can see this very clearly in this chart. So this chart breaks OPEX down into the 3 main buckets. So R&D expense, marketing and selling, and then general and administrative. And you can see that R&D was the driver of the OPEX increase, while all other cost items actually saw a long-term downward trend. So Meta must be deploying technology to become more efficient. Otherwise, you cannot explain the marketing and sales expense decrease or the general and administrative expense decrease. So in bottom line, Meta is going all in on R&D. And this massive spike in R&D expense, or a continuous upward trend, I think is reflective of these massive comp packages that we have seen in the market. So this chart then shows you, again, a relative perspective. So OPEX margin broken down into the 3 key drivers. And this chart confirms what I just said. Meta can actually afford these crazy hikes, since the R&D spend relative to revenue actually came down slightly quarter over quarter. And based on a sort of a long-term trend, is actually just in line, not even elevated. So bottom line is, even though this R&D spend increase looks crazy in absolute numbers, on a relative basis, we can see it's actually totally within Meta's norm. And the other observation is that Meta becomes increasingly efficient on all the other non-R&D OPEX. The net result of all of that you see on this slide, this shows you operating profit. And operating profit came in at an all-time second quarter high of 20.4 billion and is up by a shocking 38%. And no, this was not on a low prior year basis. The first 6 months are up 32.6% to 38 billion. So incredible performance given this massive scale. So the rest of the year, based on this trend, is looking really, really strong. And just one thing to point out, because Meta is an ads business, the fourth quarter around Christmas shopping, etc., is always the strongest, as you can see in this chart, except when there are one-time effects. And this is slightly, when you first look at this chart, clouding the all-time high performance Meta right now delivers. Let's look at it on a relative basis. So now we look at operating margin. So operating margin is just operating profit divided by total revenue. And you can see at 43% in the second quarter, this is also a long-term high for a second quarter. This is up 5 percentage points year over year. Now let's look at net income, and I just skipped a few P&L line items because they are not needle movers. I skipped over non-operating items and taxes, but frankly they are a waste of time. There's nothing to see there. But net income is a different story. Net income is up 36% year on year to 18.3 billion, and the first 6 months are now up 35% year on year to 35 billion. But of course, thus far we haven't talked about cash flow, but we'll get to this in a moment, because this is the question everybody is asking about: is Meta overspending on AI infrastructure? And we will get to an answer in this presentation, I promise. Here again, relative metric, net income margin, so net income divided by revenue. Again, very strong, very high for a second quarter at 38.6%, up 4.1 percentage points year over year. Please note the seasonality that you see in these numbers. Meta tends to outperform in the second half of the year. So right now we have no reason to assume it will be different this year. So now we look at cash flow. So let's start first with operating cash flow. At an all-time high for a second quarter, up 32% year on year to just under 26 billion. Now we look at capital expenditures. So this number reflects Meta's AI infrastructure spend and various other capital investments. And you can see in the second quarter, CapEx was up 101%. And you just saw Meta generated 26 billion operating cash flow, so they can easily pay for 17 billion in CapEx. There's still 9 billion left. Some people listening right now might think, oh, but Meta is buying back shares. If they keep spending like this on AI infrastructure, they have to stop that. That will be negative for the share price. Well, we get to this in a second. But first, let's look at the net result of operating cash flow and capital expenditures. The net result is free cash flow. So you take operating cash flow less capital expenditure, and that gives you free cash flow. And in Meta's case, there was 8.6 billion in the second quarter. That is down 22%. So the massive hike in AI infrastructure spend did leave some mark on Meta's financials. But now let's talk about the share buyback. For that, we need to look at financing cash flow. So financing cash flow includes share buybacks, dividends, net change in debt. And whenever you return more capital to both equity holder and debt holders than what you newly issued or raised from them, the financing cash flow is negative. And this is the case in Meta. So Meta's financing cash flow was negative 16 billion in the second quarter. So net Meta returned 16 billion more than what they raised from any type of capital provider. So this means we can already see Meta used its balance sheet. So what happened is, because the cash flow dropped to just under 9 billion, and free cash flow, and they returned 16 billion, there was a depletion of cash reserves. And this is what we see on this slide. So the people who understand how all this works might be looking at this chart right now. If cash flow was around 9 billion and financing cash flow was around negative 16 billion, cash balance should have decreased by just around 7 billion. But the decrease I'm showing you is around 23 billion quarter on quarter. So what is going on? So the answer is simple. Meta bought 15 billion in stock of companies that are not listed. And they showed this on the balance sheet under the item non-marketable equity investments. And that balance increased by 15 billion. That item is shown in investing cash flow, which I have not included in this presentation. So in other words, had Meta not bought these shares, Meta's cash balance would still sit at 62 billion, despite the crazy AI infrastructure investment. This further corroborates my assertion that Meta can actually afford this very high level of AI spend. And as I discussed previously, this is the obvious thing to do for Meta, because Meta is extremely threatened by AI, and that's why going all in on AI, which means being one of the biggest spender on AI infrastructure, is the logical conclusion. Before we finish, I just want to real quick cover debt, because this is a point that always comes up. So this is what you see on this slide, and you can see debt stayed constant at just under 29 billion. At that level, Meta has still a relatively low leverage ratio at just 14%. This leverage ratio is defined as debt divided by capital, and capital is defined as the sum of debt and equity less intangible assets. I worked on large debt issuances to corporates, and I can tell you Meta's credit profile is so exceptionally strong that investors globally would jump at the opportunity to buy some debt from Meta. So if they wanted to raise, let's say, another 10 billion, they could do this within a few days. No problem whatsoever at relatively low coupon. So the bottom line is Meta fires us out of all cylinders. Very strong growth, very strong profitability, very high earnings generation, very high cash flow generation, strong capital return, still very strong capital base, excluding these one-off items. Low debt leverage provides Meta with ample capacity to raise capital should they have need. So this is all very positive for Meta, but this is also very positive for Nvidia. Meta can certainly sustain the current level of AI infrastructure spend as long as they maintain the current business performance. And given how quickly they grow, I think it's a bit unreasonable to assume that all of a sudden they hit the wall and their crazy over 30% earnings growth all of a sudden drops to zero growth. And also keep in mind the strongest quarters this year are still ahead of Meta. And I think this is why they also guided for the strong CapEx increase. If we jump back real quick to capital expenditures, you can see over here the guidance they provided yesterday. And they said they would expect between 66 to 72 billion CapEx in 2025. And down here you can see they already spent just under 31 billion. So if we just look at the low end, we know they will spend even more in the second half than they did in the first half. So this is very strong read across to Nvidia. I hope this was helpful to get a better sense of Meta's performance and also what it means for Nvidia. Thanks for listening. See you in the next one. Bye.